We are seeing some of the biggest shakeups in our economy and the housing market at the exact same time, with Doge cutting waste, with tariffs on foreign imports, and mass deportations all happening at the exact same time. Now, I've already talked about how many of these changes have an impact on our economy, but what I want to do in this video is talk about how all these changes impact the housing market. For example, mass deportations could mean that there are labor shortages when it comes to construction. More federal layoffs could mean more foreclosures, and tariffs on construction materials could mean that building a house becomes more expensive. More specifically, the 5 economic changes that I want to go over, which have an impact on the housing market, include number 1, mass deportations, number 2, federal employee layoffs, number 3, tariffs on the housing market, number 4, all the changes and confusion and dilemma when it comes to mortgage rates, and number 5, privatizing Fannie Mae and Freddie Mac. You definitely want to stick with me until the end of this video because you'll see how everything starts to tie into one another. So let's start with number 1. What do deportations have to do with the housing market? And to be clear, I'm not here to talk politics. I'm here to talk money, finance, and investments. That way you can take better care of yourself and your family, because I don't want you to rely on the White House to take care of your house. The Trump administration is working to deport a lot of illegal immigrants, which impacts the supply side of the housing market and the demand side of the housing market. You'll want to understand this throughout the whole video because the housing market ultimately depends on supply and demand. When you have more sellers than buyers, more supply than demand, that generally pulls housing prices lower because now all the housing sellers are going to compete against each other by cutting the prices of their homes to bring in a buyer. On the other side, when you have more demand than supply, you have more buyers than sellers. Now the buyers have to compete against each other to buy a house. And how do they compete? Through bidding wars, by offering more money, which can push housing prices higher. So now the question is, how do mass deportations impact housing demand and housing supply? Well, I did some digging, and according to the National Immigration Forum, 10 to 19% of the construction force are undocumented immigrants. Now, as a licensed attorney, who's not your attorney, what I can tell you is that an undocumented person is a very vague term. Are you undocumented because you came into the country illegally and you don't have any paperwork, or are you undocumented because you left your paperwork at home? But that's beyond the scope of this video. What I want you to understand is that if 10 to 19% of the construction force that are building houses are undocumented immigrants, and a big chunk of them are deported, well, that could mean that building new houses gets more difficult because there's not enough labor or more expensive labor that needs to do that. And that could potentially drive up the cost to build a house, which is why we're seeing some construction companies get a little nervous. That means mass deportations have the potential to decrease the supply side of the housing market. Now let's talk about the demand side. If you live in the United States and you're not homeless, you need a roof over your head. And if people are being deported, that means there's less people that need a roof over their head, less potential tenants, less potential home buyers. But deportations are not anything new. Let me show you what I mean. During President Obama's first term as president, he deported 2.9 million people. During President Obama's second term, he deported 1.9 million people. During President Trump's first term, he deported 1.5 million people. And then during President Biden's first term, he deported 1.49 million people. Now the question is, how many people is Trump going to deport in his second term in office? And all we know as of now is he says more. There have been some estimates where he says he wants to deport as many as 1 million people a year, but we'll ultimately see what happens. What does this tell us? That deportations really are not anything new, and they might not impact the demand side of things as aggressively as we might have thought, assuming that the deportations are not anything drastically different than what we've seen over the past few years. But they might be. So we don't really know exactly what's going to happen yet, but if people are leaving the country, then we know that there's less demand for those houses available for sale because there's less people that are buying them. Again, to what extent? Well, we don't ultimately know. We'll see. But this is what we know as of now. Now that we understand how the deportations can impact the housing market, let's talk about how layoffs in the government can impact the housing market. Now, I said this in the beginning of the video, but we're seeing a lot of changes happen in the economy very quickly, faster than what a lot of people thought, which is why on March 11th, I'm hosting a free live and virtual wealth building workshop where I'm going to be going over number 1, what are some of these changes that we're seeing happen from Trump's economic policies to Doge, to tariffs, to things like technology and AI, and how do all these things create new and unique investment opportunities? So if you're an investor and you want to understand how all these changes can create a potential investment opportunity for you, it's a free workshop. It's a live workshop that I'm going to be hosting. I'm doing it twice on March 11th. one in the morning at 10:30 a.m. Eastern Standard Time, and then again in the evening at 8 p.m. Eastern Standard Time. So if you want to come, it's free. You just have to save your spot because there are a limited number of people that can join me live, and I have the link for you to join down in the description below. Now, talking about these layoffs, the United States government is in a lot of debt. Now, when you're in a lot of debt, you can either work to increase your income, which in the government's case, that means collect more tax dollars, or you can work to cut your expenses. That way you have more money to pay down your debt. And in the government's case, cutting expenses means cutting government expenses. Well, what we know is that the Trump administration is not super keen on increasing tax income because Trump has just talked about passing a major tax reform which would cut taxes for many people and businesses across the board, which means that they're not too interested in increasing tax income. Based off of what we see today, potentially maybe from tariffs, but I'm not going to talk about that in this video. But it does look like the government wants to cut expenses. The Trump administration has been working with DOGE to find waste and cut expenses in the government. This includes finding the times where the government pays 80 times more for a soap dispenser, and it could also mean laying off an entire department that works for the government. Here's why this matters for the housing market, because if thousands of people get laid off, whether it's from a private company or whether it's from the government, those people that get laid off then ultimately lose an income. So I'm not talking about what's happening in the government right now. I'm talking about the people. If you get laid off from Apple or Amazon or Meta or wherever, you lose your income. It's no different from here if you're working from the government. If you lose your job, you lose your income. Well, if you lose your income, you're probably not going to want to go out and buy a new house. And you might also struggle to potentially keep making your housing payments. What that means is if we continue to see a lot of people lose their jobs, that could potentially reduce the demand to buy a house, at least for those federal employees, because people that get laid off are generally not the prime housing buying market because most people don't go out and make a big purchase as soon as they get laid off. Likewise, on the supply side, if you get laid off, you might be more incentivized to sell your house if you have equity in there, so you have more cash in your pocket. Or it could potentially lead to more foreclosures as well if you stay in your house and you have trouble making the payments. Again, we don't know exactly what's going to happen with this because we don't know the extent of the layoffs just yet, and we don't know how the economy is going to absorb those layoffs just yet. But this is something you're going to want to pay attention to over the next 12 to 18 months. And of course, yes, I'll be keeping you updated with what's going on here on my channel and in my free financial newsletter Market Briefs, which I also have for you down in the description. Now that we've talked about layoffs, let's talk about tariffs, because this one is very interesting and a lot of people are not paying attention to this. Canada is one of the largest suppliers of lumber into the United States, and what do you need to build a house? You need wood, you need lumber. Well, on February 1st, 2025, Trump passed a 25% tariff on imports from Canada, which includes lumber, which would essentially mean if you're going to build a house and you need to buy wood, that wood might cost you 25% more. But then things changed, because a few days after those tariffs were passed, Trump paused those tariffs until March. So right now we're in a waiting game to see what will ultimately happen. That being said, let's play with the assumption that tariffs do get approved and they get passed, and now lumber gets more expensive. If lumber gets more expensive, that could potentially mean that, well, later down the line, building a house might get more expensive. Home renovations might get more expensive. What happens as things get more expensive? Well, basic economics will tell you that generally demand goes down, because as the price of something goes up, generally demand for that thing goes down. So if these tariffs do get approved and lumber gets more expensive and building a house gets more expensive and home renovations get more expensive, we could see the demand to buy a house go down, which means if you can afford to buy a house, you might be competing against less people. But again, only time will tell. Oh baby, we are really moving along. Now let's talk about the mortgage rate dilemma that we're seeing right now, because mortgage rates are still very high. And Trump has promised lower mortgage rates. So the question is, what might be coming? Now, when I say mortgage rates are very high, I'm speaking in relative terms over the last 2 decades. If we take a look at the last 5 decades, the last 50 or so years, we'll see that 7% mortgage rates are really not that high in the grand scheme of things. But based off of what many of us know over the last 10 or 20 years, the 7% mortgage rate seems a whole lot higher. But here's what's interesting. The government, meaning Trump and the Trump administration, are not in charge of setting mortgage rates. Either is the Federal Reserve Bank. Your mortgage rate is ultimately set by your bank. But the thing that impacts how low your bank can charge for these mortgage rates depends on the Federal Reserve Bank and the interest rate that the Federal Reserve Bank sets. This is called the federal funds rate. And now the Federal Reserve Bank is saying that they're not too keen on cutting interest rates very aggressively in 2025 because they are concerned. They're concerned about inflation, they're concerned about the economy, they're concerned about tariffs. And because of those concerns, the Federal Reserve Bank does not want to cut interest rates right now, which could make it more difficult for your bank to bring mortgage rates down to 5 or 4 or 3%, because the Federal Reserve Bank doesn't want to cut interest rates that aggressively in 2025 based off of what we know today. On the flip side, the Trump administration has talked about bringing mortgage rates down drastically. During his campaign, Trump talked about bringing mortgage rates down to 3%. Is that going to be possible? Well, based off of the system that we have today and the information that we have today, it looks pretty difficult. But that doesn't mean that nothing is possible, because there's always what I call the X factor, which is something new that we don't know today. Maybe the government could create a potential government subsidy on people that want to buy a mortgage. Maybe the government could create some sort of new program to help people get lower mortgage rates. Will that happen? I have no idea. But this is something you have to think about, because as of now, mortgage rates don't look like they're going to be falling drastically in 2025, unless something changes with the X factor. So if mortgage rates stay high, well, that might not impact supply or demand, because, well, I think people are starting to get more used to the 7% mortgage rate. If mortgage rates fall, then that could potentially increase demand, because more people will say, oh, a 4% mortgage rate? Now I'm interested in buying a house because I can afford the mortgage payment unless housing prices shoot back up as more people go out and make offers on those houses again. And on the flip side, lower mortgage rates could also increase supply, which might seem a little bit weird. And the reason why is because we have a lot of homeowners, the majority of homeowners, that are sitting on a house with a sub 5% mortgage rate. So if you bought a house in 2021 and you have a 2.8% mortgage rate, you probably don't want to sell, because if you sell, now you have to give up that nice low mortgage rate and then go to a 7% mortgage, which people don't want to do. But if mortgage rates fall drastically, well, now going from a 2.8% mortgage to a 4% mortgage doesn't seem as steep, and more people might be interested in listing their homes for sale. Or if you have a 3.5% mortgage rate, going from a 3.5% mortgage rate to a 5% mortgage rate, you can see how that's not as bad as growing from a 2 or 3 or 3.5 or 4% mortgage to a 7% mortgage. That's why lower mortgage rates could impact demand and supply. And now last but definitely not least is talking about privatizing Fannie Mae and Freddie Mac. And for those of you that are, let's call it, over the age of 30 and you remember the 2008 financial crisis, you probably remember the names Fannie Mae and Freddie Mac. Let's talk about this. Fannie Mae and Freddie Mac used to be private companies. You could buy shares of them on the stock market. And then the 2008 financial crisis happened and they went underwater, and then they were taken over by the government. Now they are known as GSEs, government-sponsored entities, which means they're kind of private companies, but they're also taken over by the government, so the government is funding them and making sure that nothing goes wrong. That's what they are today. But you might be wondering, well, what the heck is the Fannie Mae and Freddie Mac? Let me read you their description. According to the Federal Housing Finance Agency, their job is to provide liquidity, stability, and affordability to the mortgage market. Now at this point, you're probably more confused than you were before. So let me diagram this for you. Let's assume that this is you. For my male followers, I drew a mustache, which in my native language Punjabi we call a much. For my female followers, I drew a braid, which in my native language Punjabi we call a gut. You go to the bank, whether it's Chase Bank, Bank of America, doesn't matter, and you go out and you get a mortgage. Now, when the bank sells you that mortgage, they don't want to have to wait 30 years to get their money back, because they're not going to be able to continually keep lending out more and more money, because they're going to run out of money if they keep giving people money and then they have to wait 30 years to get that money back. What banks do is they sell you the mortgage, and then they take this mortgage and they sell it to Fannie Mae and Freddie Mac. Because now Fannie Mae and Freddie Mac give the bank the money plus some profit, that way now the bank can go and issue more loans to other people. So Fannie Mae and Freddie Mac are buying these mortgages from many different banks. That way banks can continue to have liquidity, because if they kept lending out this money and had to wait 30 years to get their money back, they wouldn't be able to keep making those loans. And this then begs the question, what would happen if you privatize Fannie Mae and Freddie Mac as opposed to keeping them as government-sponsored enterprises? Well, if they become private companies and they don't have the backing of the United States government, then they might not buy every single loan that Chase Bank and Bank of America and every other mortgage company is going to keep selling them, because now Fannie Mae and Freddie Mac got to be a little bit smarter with their money, because if somebody doesn't pay their mortgage, well, now Fannie Mae and Freddie Mac have to absorb that loss as opposed to the United States government. And when it's the United States government, it's ultimately the taxpayers that are absorbing the loss because the United States government doesn't have a huge supply of cash. They're in debt. So Fannie Mae and Freddie Mac are now responsible for all the risk. They might have to be a little bit more stringent, and that could potentially force some banks to offer or charge higher interest rates. Take a read. This is from CNBC. Therefore, you will demand a higher interest rate to compensate for that risk, meaning privatizing Fannie Mae and Freddie Mac, and therefore mortgage rates will be higher as well. Again, this is all speculation. We don't know exactly what would happen. We don't know what rules would be given to Fannie Mae and Freddie Mac. We don't know what backstops would be given to them. This is all people speculating what could potentially happen. But if that were to be privatized, you could bet that that would shake up the housing market or mortgage market to some extent. And how would it impact supply and demand? Well, if mortgage rates do go up, that could potentially lower demand and potentially lower supply as well, because if you have a 30-year fixed rate mortgage at 4% and now mortgage rates are 8%, well, you could potentially be less likely to sell your house. How much less likely? I don't know. I would just be guessing. But that's something you want to consider. But again, this is all questions. We don't know exactly what happened here as well. And then on top of all of this, we have the X factor, which is what else would the government put in regulations to change this? We all know what happened during the 2008 financial crisis, where a lot of people lost their houses, a lot of people or businesses got bailed out, and ultimately fell under the taxpayer again. So it can get very complicated, which is beyond the scope of this video. But what I want to get at today is that privatizing Fannie Mae and Freddie Mac could impact the housing market. To what extent exactly, we don't know, but it's something that you want to keep your eye on, which is why we're having a lot of changes in the economy right now. These changes don't just impact the economy at large, but they do also impact the housing market. These things might not be apparent today or tomorrow or next week, but it's something that you want to keep your eye on, especially over the next 6 months, 12 months, and 18 months as things start to get absorbed into the economy. Again, I'll be keeping it posted here. You can join Market Briefs, which is my free financial newsletter, to stay up to date on what's happening. That link is for you down in the description. And then if you're an investor and you want to understand how these things can create a unique investment opportunity, on March 11th, I have my free workshop, and I have that link for you down in the description as well. President Trump is now considering getting rid of the income tax. Take a listen.
As I said in my speech last week, instead of taxing our citizens to enrich foreign nations, we should be tariffing and taxing foreign nations to enrich our citizens.
The Fair Tax Act of 2025 was a bill proposed which would effectively abolish the IRS.